And for that reason, US Fed will not be increasing the rate of interest further, because if it happens, then US will face the economic challenge and it may bring sovereign debt crisis in the US, and that will lead to major economical collapse and stock market crash. Hello everybody, let me welcome you to your own channel, The Secrets of Wealth, after a long period of time. In today's video, I'll be discussing how much the rate of interest can go and what are the consequences that it can bring, and whether it can invite another major economic downturn or most certainly the US debt crisis. Today's video will be based on some untold events and thoughts that might help you to take your investment decisions in the stage of this economic turmoil. But as the topic of the discussion seems to be lengthy and complex, the entire video has been divided into two parts to keep it interesting and understandable. So without wasting your time and the time of mine, let's begin. In today's macroeconomical discussion, I will be taking care of two major economic parameters that need to be taken care of to take any financial conclusion. Among those, number one parameter is fiscal deficit or budget deficit, and number two is current account deficit. So here we start. Number one, fiscal deficit or budget deficit. The difference between the total income and the total expenditure of the government is called the fiscal deficits. It reflects the internal strength of the government to run any country. Higher is the deficit, more is the debt requirement, and lower deficit or fiscal surplus indicates more money government can spend towards country's development and represent a stronger economy. So now let's understand this concept very simply. Debt has always been one of my favorite topic of discussion. Since the global financial crisis of 2008, the US sovereign debt has reached at its all-time high at 30.93 trillion US dollar. That is in total 124% of the US GDP. That's not a big problem till dollar stays the reserve currency of the world, but the problem arises with the increasing interest payment over the period of time to maintain such a large debt inside the economy. And to curb this high inflation in the US economy with the increasing interest rates, the US government debt interest repayment every year seems to be very critical and challenging, as with the increasing rate of interest, the interest repayment amount is also increasing significantly. While in the year of 2021, when the national debt was 28.4 trillion US dollar, US had to pay 392 billion US dollar as interest payment. In the year 2022, in total debt has turned 30.93 trillion US dollar, and the US need to pay 399 billion US dollar to its debt holders as per the CBO reports. That means more the interest rate will be increased by US Fed, more the interest have to pay in future. Presently, US spends 965 million US dollar in interest repayments every year, and now the interest rate of US is 4%, that is highest since 2008. If in order to curb the inflation, the interest rates are kept increasing further, then US government have to keep paying higher interest cost every succeeding year to its debt holder, resulting US budget deficit. That means less amount in the US budget will be allocated for social developments, infrastructure growth, job creation and social securities. According to the CBO's projection, if the Fed increases the interest rate further in big amount, then in next 10 years it can reach up to 8.1 trillion US dollar, and it could be 40% of the total Fed's revenue by 2052. In that case, government will be able to spend less towards its country's economic development, and according to the CBO's estimation, if such situation persists further, then the US government's interest cost can be 3 times of what federal government has historically spent on research and development, non-defense infrastructure and education combined. Forget their 2052. If such situation keep happening in the economy for a longer period of time, and if the rate of interest keep increasing for a longer period of time in every Fed discussion and its policy making, then at that time government have to cut its budget, and for that reason the Medicare, social infrastructure, social securities, defense and non-defense items will be cut off and their budget allocation will be declined, because government have to pay extra interest as repayment of its debt. That probably going to hurt the normal Americans. As per the CBO or Congressional Budget Office of the year 2022, the US budget deficit likely to stay at $1 trillion US. But the problem is that with lower GDP growth and slower economic activities, government revenue is not increasing rapidly to fund its deficits. In these odd economical conditions, with every basis points of raising interest rates will inversely increase the US fiscal deficits burden in the hand of higher debt interest repayments. If to meet this interest repayment challenge, US government cut its defense budget along with social security and Medicare cost, then it will create an unprecedented wealth gap between rich, middle class and poor, resulting social unrest inside the country, leading to political instability, may end up in civil war. Additionally, investors will lose their confidence and hope on US and US debt repayment capabilities and US debt instruments, resulting sovereign debt crisis in US. Recently, we have seen similar type of situation in Greece, Sri Lanka, Pakistan, Turkey and Argentina. Then what to be done in this case? There is only one way left, that is US government have to increase its revenue, and they can do it by increasing taxes on individual income that contributes 55% of its total revenue, social securities that contributes 34% on total revenue, corporate and business taxes that contributes 5% of the total revenue. And if such thing happen, then taxes combined with higher inflation rate will decrease the personal savings further. That will be badly impacting the already lowering consumer sentiments. As a result, people will be buy less products that comes under the consumer durables item except the basic food and basic daily essentials. And as a result, in one hand, corporate production except basic foods and daily essential items will be lowering along with their revenues. On the other hand, possibly with the higher tax rates, corporate earning along with the corporate profits will be declining further, leading to job cuts and increasing unemployment rates. Possibly will end up with most awaited lower inflation in the economy. Though in one hand that might bring inflation under control, but that will cause a major stock market crash and economical crisis. Recent job cuts in Google, Twitter, Facebook perhaps indicating the same phenomenon that has already started to happen. And the possibility is there that such job cuts will be accelerating in upcoming months, because it is already proved that only interest rate hike is not adequate enough to control the inflation. US Fed and US government have to consider the revenue increment too, otherwise they have to face a major sovereign debt crisis in long term. Considering that fact, I believe that we might see a Fed policy change and the Fed will not increase the interest rate above the current level. So this one was the part 1 of today's discussion. In the second part of this discussion, I will be disclosing why current account deficit is so important and why people should consider the current account deficit to understand what would be the next Fed's movement. If you find this video helpful and full of information, then kindly subscribe the channel and press the bell icon so that you can get all the notifications whenever I'll be posting any video in this channel. And kindly share this video with your friends, colleagues and relatives. Till then, bye bye.